ICICI Bank's move to acquire ICICI Securities has sparked significant controversy, thrusting India's market regulator Sebi into the spotlight once again. Less than a month after US-based short seller Hindenburg Research raised some serious allegations against Sebi, the regulator is now facing fresh scrutiny over its role in ICICI Bank's contentious buyout of its brokerage arm. According to a report by Bloomberg, some shareholders of ICICI Securities are raising eyebrows over the terms of this acquisition, particularly questioning how Sebi permitted the delisting of ICICI Sec without adhering to its own rules that protect minority investors. Despite a company law tribunal in Mumbai dismissing these shareholders' challenges on August 21, the legal battle is far from over. The dispute has now escalated to a separate class action suit in New Delhi and is being heard by a high court in Mumbai. A major point of contention lies in Sebi granting ICICI Bank a key exemption in its acquisition process. You see, last June, ICICI Bank announced plans to acquire the remaining shares of ICICI Securities by offering a share swap. 67 shares of ICICI Bank for every 100 shares of ICICI Securities. Now, Sebi's regulations require a bidding process to determine a fair value when a company is being delisted from the stock exchange. This ensures that all the shareholders, especially the minority ones, receive fair compensation. However, there is an exemption to this rule if the company is being acquired is a subsidiary that operates in the same line of business as the acquiring company. In this case, ICICI Bank and ICICI Securities operate in different sectors, banking and securities respectively. Now, despite this, ICICI Bank requested Sebi to exempt them from the bidding process, and Sebi granted this request in June, allowing ICICI Bank to proceed with the acquisition without having to determine a market-based fair price through bidding. Although the acquisition was approved by 72% of ICICI Securities shareholders in a March vote, the process has been clouded by controversy. The brokerage allegedly shared personal data of minority investors with ICICI Bank, leading to direct outreach from bank employees. Sebi later criticized this move, citing a conflict of interest and issued an administrative warning to both ICICI Bank and ICICI Securities. Yet, this reprimand hasn't quelled all concerns. Over 100 non-institutional public investors of ICICI Securities have banded together to file a class action lawsuit, a rare occurrence in India's securities market. Bengaluru-based fund manager Manu Rishi Gupta, who was cited in this Bloomberg report along with the other disgruntled shareholders, argue that the skewed share swap ratio has cost investors over $200 million. They claim that in a booming market, ICICI Bank is effectively acquiring ICICI Securities' substantial cash reserves and investments valued at a whopping $1.4 billion just at a bargain price. On the other hand, ICICI Bank and ICICI Securities maintain that the merger terms were determined by independent valuation experts and deemed fair by multiple proxy advisory firms. The broader and more pressing question over here, however, remains for Sebi. Why was ICICI Bank allowed to bypass the established bidding process, and under whose authority was this exemption granted? The outcome of this legal tussle could set a precedent for how large companies might maneuver to absorb their listed subsidiaries in the future. Now, this situation is still unfolding, and the implications for both Sebi, ICICI Bank and ICICI Securities, as well as the Indian market at large, are yet to be fully realized. As the legal proceedings continue, all eyes will now be on Sebi to see how it navigates this complex and highly scrutinized scenario.